Welcome to our well-rounded course on capital markets. Join us as we discuss different topics in this area. Let's dive in. Capital markets are where companies and governments raise long-term funds. The primary market is where new securities are issued, while the secondary market is where existing securities are traded. The derivatives market deals with financial contracts based on underlying assets. When it comes to investing, understanding the difference between the primary and secondary markets is crucial. In the primary market, securities are issued for the first time, while in the secondary market, investors trade previously issued securities. This distinction is important for investors to make informed decisions about buying and selling securities. Bond markets play a crucial role in the global economy by providing a means for governments and corporations to raise capital. Investors can diversify their portfolios and earn fixed interest income through bond investments. Understanding the dynamics of bond markets is essential for financial stability and growth. Now let's head to the next slide. Derivatives markets involve financial instruments whose value is derived from an underlying asset. These instruments play a crucial role in risk management, price discovery, and hedging strategies in financial markets. Exchange-traded derivatives are standardized contracts traded on organized exchanges, while over-the-counter derivatives are customized contracts traded directly between parties. Market participants include hedgers, speculators, and arbitrageurs. All right, let's advance to the next topic. Equity financing is a method of raising capital by selling shares of a company to investors in exchange for ownership. It is a way for businesses to raise funds without incurring debt. Investors become partial owners of the company and share in its risks and rewards. While equity financing does not require repayment like debt financing, it can lead to dilution of ownership and loss of control for existing owners. Dividends may need to be paid to shareholders as well. Debt financing is a common method used by businesses to raise capital. It involves borrowing money from lenders or issuing debt securities to investors. This method allows businesses to access funds without diluting ownership. However, it also comes with the obligation to repay the borrowed amount along with interest. Businesses can choose from various types of debt financing options such as bonds, loans, or lines of credit. Each option has its own terms and conditions regarding repayment and interest rates. It is essential for businesses to carefully consider their financial situation and goals before opting for debt financing. Public offerings are a method used by companies to raise capital by offering shares of their stock to the public. This process involves regulatory requirements and careful planning to ensure success. Investors can purchase these shares through the stock market. Becoming partial owners of the company, companies may choose to go public for reasons such as expanding their business, funding new projects, or paying off debt. Benefits of public offerings include access to capital for growth, increased visibility, and liquidity for existing shareholders. However, stock prices can be volatile and subject to market fluctuations. Private placements offer companies a way to raise capital without the need for a public offering. They are typically offered to a select group of accredited investors and have less regulatory requirements compared to public offerings. Companies can benefit from the flexibility in structuring the offering and access to capital from private investors. Now let's head on to the next topic. Market participants are individuals, businesses, or entities that engage in buying and selling activities within a market. Buyers are those who acquire goods or services, while sellers are those who offer goods or services for sale. Intermediaries act as middlemen, facilitating transactions between buyers and sellers. Investors provide capital in exchange for ownership or future profits. Understanding the roles of market participants is essential in comprehending market dynamics. Let's head on to the next topic. Stock exchanges play a crucial role in the global economy by providing a platform for buying and selling securities. They offer liquidity, transparency, and regulation to ensure fair trading practices. Investors can participate in the market to grow their wealth. But they also face risks such as market fluctuations and speculative behavior. Understanding how stock exchanges operate is essential for anyone looking to invest in the financial markets. Market regulation involves the establishment and enforcement of rules to ensure fair competition, protect consumers, and maintain market integrity. Regulatory bodies such as the SEC and SCEF play a vital role in overseeing market activities. Regulations help prevent monopolies, promote transparency, and create a level playing field for all participants. The Securities and Exchange Commission (SEC) is a vital regulatory agency that plays a crucial role in overseeing the securities industry, enforcing securities laws, and protecting investors. It regulates various entities in the securities world and enforces laws to combat fraud and ensure market integrity. The SEC's mission includes investor protection, market transparency, and enforcement of securities regulations. Financial intermediaries play a key role in the financial system by connecting those who have excess funds savers with those who need funds borrowers. They provide various services such as pooling funds, reducing risk, and providing information to ensure efficient allocation of capital. By utilizing financial intermediaries, individuals and businesses can access a wider range of investment opportunities and financial products, ultimately contributing to economic growth and stability. Market efficiency is a key concept in finance that posits that asset prices reflect all available information. This means that it is difficult for investors to consistently beat the market by exploiting information that is already known. The efficient market hypothesis is a central theory related to market efficiency, stating that it is impossible to outperform the market consistently based on available information. Investors should consider the implications of market efficiency when making investment decisions, focusing on strategies like diversification and index investing. Risk and return in capital markets involve understanding the trade-off between the potential for gains and the possibility of losses in investment activities. Investors evaluate the level of risk associated with an investment and the expected return it may generate. This analysis helps in making informed decisions to achieve financial goals. Now let's continue with the next topic. Portfolio theory involves the principles of diversification, asset allocation, and risk management in investing. By spreading investments across different asset classes such as stocks, bonds, and real estate, investors aim to reduce risk through portfolio diversification. Asset allocation involves strategically dividing investments among various asset classes like equities, fixed income, and commodities to optimize returns. Risk management strategies, including insurance hedging and diversification, help investors mitigate potential losses in their portfolios. The capital asset pricing model (CAMP) is a financial model that describes the relationship between systematic risk and expected return for assets, particularly stocks. CAMP is used to determine an appropriate rate of return for an asset based on its risk, taking into account the asset's sensitivity to market risk beta and the risk-free rate of return. Some pros of CAMP include providing a method to quantify the risk-return relationship and offering a benchmark for evaluating investment decisions. However, there are cons as well, such as relying on assumptions that may not always hold true in the real world and not accounting for all factors that may influence asset returns. Arbitrage pricing theory. APT is an asset pricing model that predicts the expected return of an asset based on the relationship between that asset and multiple risk factors. APT considers various sources of risk that can affect an asset's return, allowing investors to make informed decisions about their portfolios. Multiple risk factors influence asset returns, and investors seek to exploit pricing discrepancies to capitalize on arbitrage opportunities. By analyzing these factors, APT helps in estimating the expected returns of assets and contributes to market efficiency. APT is widely used in finance to assess the impact of factors like interest rates, inflation, and economic indicators on asset returns. Understanding and applying APT can aid investors in managing risk and maximizing returns in their investment strategies. Behavioral finance in capital markets studies how psychological factors influence financial decisions. Investors are prone to biases such as loss aversion, overconfidence, and herding behavior, which can lead to market inefficiencies. Understanding these behavioral patterns is crucial for making informed investment decisions. Market microscrecher is a field of study that examines the ways in which the trading process and market organization influence price formation and market liquidity. It delves into the details of how orders are placed, matched, and executed in financial markets. Understanding market microscrecher is crucial for investors, traders, and regulators to comprehend the intricacies of market dynamics and make informed decisions. International capital markets play a crucial role in the global economy by enabling the flow of funds between countries. Participants in these markets include governments, financial institutions, and individual investors. The benefits of international capital markets include diversification, access to a larger investor base, and lower cost of capital. Key instruments traded in these markets include bonds, stocks, and derivatives. However, there are risks involved such as exchange rate fluctuations, interest rate changes, and political instability. Now, let's go to the next slide. Emerging capital markets play a crucial role in the global economy by providing opportunities for growth and investment in developing countries. These markets offer both benefits and challenges for investors and businesses looking to expand their operations. Investing in emerging capital markets requires careful consideration of risks and opportunities, as well as an understanding of the unique dynamics of each market. Despite the challenges, many investors are drawn to these markets for their high growth potential and diversification benefits. Now let's head to the next topic. Capital market trends and innovations involve the continuous evolution of financial markets driven by technological advancements and changing investor preferences. From the adoption of digital platforms to the emergence of new asset classes, the capital market landscape is constantly adapting to meet the demands of a modern economy. Key trends include the increasing use of algorithmic trading, the growth of sustainable investing practices, and the integration of artificial intelligence in investment decision-making. Innovations such as blockchain technology, peer-to-peer lending, and crowdfunding platforms are reshaping how capital is raised and allocated. To conclude, we've outlined a number of key concepts in this unit. We hope this makes some of the key topics more accessible.